In any event, this is the session on financials. Now, guys, the thing that I'm going to talk about here is the financial side of this business is not necessarily the most glamorous. And but it's really important that you understand some basic financial concepts in terms of running a business, because that's in fact what you're doing. So let me ask you a quick question. How many of you guys, when you were in real estate school, remembered going through the parts in your pre-licensing class teaching you about how to manage the finances of running your business? How many people remembered that part? Does anybody? Anybody not remember that section? Well, I can tell you, a lot of you don't remember that section because there is no section. And how do I know that? Because I'm a licensed real estate instructor and I can teach the pre-licensing courses. And I know we never cover that. And it's just difficult sometimes, because when you're trying to run a business and you don't really have a good overview of what are the key things that I need to manage, what happens is we tend to wing it. And I don't want you to wing it here. So we're going to go through what are the key things that you need to know. And let me just double check. It looks like Jorge is now hopefully able to get into the room here, and we'll go from there. All right, number one, we always start Ignite with what do successful agents do every day? And we know that they work on growing their business and do the activities of growing their business, and then they spend time in working on running their business, and certainly managing the money is an operational side part of the job. It's the running the business side of things that we're going to be talking about today. And so first thing we got to think about is habits for financially sound business. This is what we're going to unpack today. We're going to start talking about setting profit goals that can really fund the life the way that you want it to be. We're going to talk about how to estimate for and save for and pay your taxes on time. We're going to talk about proven models in terms of managing your finances, including what we call the chart of accounts, which is essentially an Excel spreadsheet ledger, if you will, that has all the different business operational lines that you would need to think about in terms of running any size real estate business. We'll talk a little bit about that and where to find that. We're going to talk about being, savvy and kind of reviewing your financials regularly. We're going to talk about the importance of paying yourself a salary. We'll talk a little bit about thinking about, should I incorporate my business, right? And again, I'm not a CPA or an attorney, so I'm not going to give you advice. But what I am going to do is raise the questions and ask you to bring those questions back to the people that you need to kind of get good, sound advice. And then we're going to talk a little bit about preparing now for kind of securing your financial future. Gary Keller has a quote that I love that says, money is good for the good it can do. And how many people want to be rich? Let me ask that question. You can put it in chat. You can unmute. Anybody ever have the dream of becoming financially independent and rich? I'd love to see either yes or no in chat. Try to get a sense of where people are with this. Well, I'm starting to see the chat box light up a little bit here. And in chat, I'm seeing some folks saying, yeah, I'd like to be rich. Here's one of the things that I'll tell you, and I've learned from my own experience as a coach. And I not only coach real estate agents, I have a coaching company outside of Keller Williams where I coach small business owners. One of the biggest challenges that people have is making peace with money. We have a lot of money issues for a lot of us. We have this fantasy, this dream of becoming rich and financially, well off. And we think about winning the lottery. How would my life change? But what really happens is, people have to learn how to turn up their thermostat to be comfortable with the idea of having money. There's a lot of things that people think about money. Who can fill in the blanks on these statements? Money can't buy me what? Somebody unmute and fill in the rest of that. Money can't buy you happiness. Money can't buy me love. The Beatles sang that song, right? Look, I've heard people say money can't buy you happiness, but you could be unhappy in a really nice place, right? The truth, though, is this. We have to learn how to get comfortable with having money, not for the sake of having money. This isn't about just material gain. This is about recognizing that money is the energy that gets things done in the world. And if you want to make an impact in the world, it's going to take money to do that. Money is good for the good that you can do with it, right? And so that's just something to think about as we kind of set off on this. And I'm going to ask you to look at two different money handling models here. And I'm going to ask you to kind of think about which one is financially sound. And we're going to start with, on the left side, we'll just go with Mary, real estate agent. And Mary gets a commission check. And that commission check is $9,000. That's what we call gross commission income. And then what happens is once she pays her brokerage fees, meaning the split that she has with her broker, once she pays the royalty, we're going to talk about both of those fees in a minute and unpack what they are and how much they are. But what she gets to keep out of her $9,000 check is $5,760. And what money agents do, and I would say maybe even most agents do, is they take that commission check and they just bring it right to their bank and they put it right in their family's personal banking account. And the money just goes right into her wallet. All $5,760 is money that is now something that Jessica, it's actually Jessica the agent, not Mary the agent. But now Jessica has $5,700 or whatever in her wallet ready to go. That's model A. On this side, we have a model where Jessica gets her $9,000 check. And what she does is she puts that check in a dedicated operations bank account, a business bank account. And out of it, in that business bank account, she puts all $5,760. She pays herself a salary here. 70% is what we're going to talk about in terms of paying yourself a salary. She gives herself 70%, which leaves $1,728 in the operations side of her business bank account that she's going to run her business on. Out of the salary that she paid herself, she's going to put 40% aside for taxes in a separate bank account. Separate bank account so it doesn't get all commingled, so that it's there when she's ready to write those tax payments. She puts that $1,630 into the tax account. Some of it goes to federal and state tax, some of it goes to self-employment tax, and what she has left over in her wallet to spend now is $2,419. I went through a lot of numbers there. This will be recorded. You can go back and watch this again. But let me ask you a question. Which one of these models is more sound from a business standpoint? I'd love for somebody to just unmute, make sure that I know that you're all here with me. Which one of these models makes the most sense business-wise? Anybody? The second one. For sure, Rashid, absolutely. The second one, in the first model, Jessica hasn't put anything aside to run her business. In the first model, Jessica hasn't put anything aside to pay her taxes. And when you don't do those things, running your business becomes very, very scary. Your business becomes very, very vulnerable. In the second model, a couple key things that you notice here. Number one, she has not run her business through her personal bank account. One of the things, if you haven't done it already, that I would encourage you to do is to go open up a business bank account. You know, for those folks when the pandemic hit, and for those agents who found themselves qualifying now for PPP loans, right, those personal payroll protection loans, you had to get those loans from your local banks, right? You had to apply for those at your local bank, and the local bank required that you had a business account there. Having a personal account did not qualify you for applying for a personal payroll loan. You had to have a business account. So if you haven't set up a business account, I'd encourage you to do it, right? The second account that you saw here is that she had a tax savings account. She kind of took a certain amount of money. We're recommending 40%. That number can vary. We'll talk about it in a second. But she takes 40% of her salary that she got paid and she put it in a separate account so that she knew that it would be there. Right, so creating these separate accounts are really important things to do when you're running a good, solid, financially sound business, right? Now, in this example, again, all the expenses were accounted for. She got a $9,000 commission. She, in total, $5,760 was what she was paid, and she walked away with $2,419 spendable income in her pocket, in her wallet, that she could spend and know that her businesses, expenses, and her taxes were accounted for. No surprises, right? Now let's talk about taxes for a minute. There's a couple things that we need to know. In fact, let me go back here even before we do that. I want to go back to this slide because I want to go back to this question. When are taxes even due? I'll talk about how much to calculate for taxes in a minute, but do you guys know when your taxes are actually due? Who can unmute or put in chat when your taxes are due? I want to make sure we have this right. Who can take a wild guess? I'm not going to move on until we get some answers on this one, because this is one of the most important things that we need to make sure of. Okay, I see April 15th. I see every quarter, quarterly. And the truth is kind of sort of right there. But here's what you need to understand. According to the IRS rules, your taxes are due immediately upon earning income. The moment you get paid, you are required that those taxes are due in that moment. Now, if you were working in a corporate environment, if you were on payroll somewhere, what happens is your payroll administrator kind of calculates what your earnings are for that pay period, and your payroll administrator takes that money out, withholds that tax, wires it to the IRS directly, typically through the payroll company, and pays it immediately. You don't have to worry about that there. That's not really practical when you run your own business, because our payments, our commission checks, they come frequently. They come in irregular time frames. It's not practical to have to send a check to the IRS every single time. It would overwhelm them to try to process a check every time you got a commission. And so what they allow us to do is they allow us to estimate and make those payments quarterly on estimated timeframes. And those estimated timeframes in most years, it's different this year because of the pandemic. The timetable changed a little bit, but in most years, you have to make an estimated payment on April 15th, another one on June 15th, a third one on September 15th, and the final one on January 15th of the next year, right? You make those estimated payments based on what you projected your income was, what you believe the estimated taxes would be, and then once a year on April 15th, when you file your taxes, is when they kind of balance the scales and they took a look and they said, were your estimates correct? Did you overpay? Did you underpay, right? The thing we've got to recognize is this: the taxes are due immediately, and so make sure that you're putting the money aside. What happens a lot of time, if you go back to this first model of Jessica, if she just spends the money and hopes that she's going to get another commission check at some point and have the money ready to pay for taxes, when those quarterly estimates are due, she's not going to have the money. And guys, I don't want you to get into trouble with the IRS. And there's, to the best of my knowledge, there's no one on this call that is, which would be really good news. But I know personally lots of real estate agents. I won't mention any names, obviously, but I can think right off the top of my head of a half a dozen agents that I know personally who are in a trouble with the IRS, that they owe the IRS in excess of $50,000 in back taxes because they spent the money and they didn't put it aside when it was time to give it to the IRS. And so don't do that, right? Put that money aside, have that tax account, okay? Now let's talk about how much. We say that you need to think about 40% for taxes. And I know that a lot of times people may say that's too high, and it may actually be. Your mileage may vary here. Do yourself a favor and talk to your tax professional and find out what is right for you. However, what needs to be accounted for is your state taxes and your federal taxes. But there's this other tax that you're required to pay as an independent business owner. It's called the self-employment tax. And that's the tax that pays for things like your Social Security and your Medicare when you retire. And when you're working in a corporate environment, your employer contributes largely to that expense. When you don't have an employer, you have to do it yourself. And the self-employment tax right now is 15.3% of your income. And so when you're thinking about making sure that you're carving out enough, then just know that you've got to account for your state and federal taxes. You've got to account for self-employment tax. Go to your tax professional and have that conversation in terms of what should you be budgeting. I will tell you that most agents find that when they bring that question up with their tax people, they hear maybe 30% is a better number, right? I'm not going to tell you what yours should be. I am going to direct you to the right person, but make sure that you account for state, federal, and self-employment, right? That's important. Now, Small businesses. One of the things that you need to think about is, does it make sense to incorporate yourself as a business entity? And again, I'm not gonna pretend to be a lawyer or an accountant. I have my personal preference. I own 3 businesses outside of what I do here at Keller Williams, and I have chosen to incorporate each one of those as an LLC. LLC is a limited liability corporation. And why I like the LLC model for my businesses is that it creates a firewall between your business and your personal finances. If anything ever happened in my business and my business was sued, if I'm working as an independent contractor and not as a business entity, then that lawsuit, if I lose that lawsuit, then everything that I own, my house, my savings, my daughter's, wedding money that I'm put away, whatever it is, all of that money is subject to that lawsuit. When you incorporate as a business, you put a brick wall between your business's responsibility and they can't get to your personal finances. All they can do is sue the business. If the business runs out of money, they can't go into your personal finances to get more. And for me, I think that makes sense. Again, you decide for yourself what makes sense for you. A couple things that you should know is that in the state of New Jersey, if you do incorporate yourself as an LLC, that your commission check cannot be made payable to that LLC. It can only be payable to you as an individual agent. That's the New Jersey state rules about paying. So you would get then a commission check payable to your name. You would take that check and you would deposit it in your bank account, which is in the name of the LLC, and that money is now behind the firewall, if that makes sense. And there's lots of different ways that you can structure a business. You can be in a limited liability corporation. That's the one that I've chosen to do. You can get into a partnership. You can get into what we call an S corporation. There's a lot of different things, and I'm not going to make a recommendation, but understand that businesses are taxed at a different tax rate than you are as an individual person. An individual sole proprietor paying self-employment taxes pay at 15.3%. But typically, what you find is that small business taxes tend to be a little different, right? If you look here, sole proprietors pay about 13.3%, small partnerships pay about 26%, S corporations pay whatever they pay here. The point of the matter is, when you're thinking about state, federal, and self-employment tax, we're saying somewhere around 30 to 40% is what you should put aside to make sure that you've got enough. Talk to your tax preparer to be sure. But when you go and become incorporated as a business, you are likely to significantly reduce your tax liability. And so I think personally, for me, it makes some sense to do that. You decide what makes sense for yourself. It's not expensive. It's not complicated to do this if this is what you want to do. You don't have to hire an attorney to do it. There are services that will prepare the necessary documents and file them on your behalf, and file them with the state, file them with the IRS, so that you can get a small business employee identification number, so you can file with the IRS. There's companies that will do this for you for $400 or $500. It doesn't have to be a big expense, and it's not necessarily one that I'm saying you should do, but I am saying that you should at least have the conversation with your attorney or your CPA to decide if it makes sense for you, and then go ahead and do that. Any questions about this part before we move on? There's a lot of moving parts here in this session today. Just want to make sure.
I have a question.
Go ahead, bring it on, Julia.
If it's even an option, because I was always under the impression that we get our commission at 1099, and it's to our personal social security number. So is there even an option to receive commission as a corporation or LLC?
No, there isn't. You can't. Your broker cannot cut a check to the name of your LLC. If you decided to call your LLC Julia's Really Cool LLC, your commission check cannot be made out to that. It has to be made out to you as an individual. However, if you take that commission check, and as the owner of the LLC, if Julia goes and she owns Julia's Really Cool LLC and she has a bank account in that name, and you are the owner of that account, then you can take that personal check and you can fund that LLC, deposit it into the LLC's bank account, thereby protecting that money through that firewall that we talked about. That's how you do it.
Got it. Thank you.
What kind of an attorney deals with creating LLCs? That's a good
Hi,
question.
I have a question.
I don't, hold on for 1 second. So I'll get to you in a second. Alexa, I'm not exactly sure what kind of attorney does that, to be honest with you. I suspect that you could probably just Google that and find out what attorney would do that. Or, call your favorite real estate attorney and say, hey, I don't know that this is something you do, but who would you direct me to? The company that I hired, and again, I'm not endorsing that you should use them, but I hired a company called CorpNet, C-O-R-P-N-E-T, CorpNet. And they're a third-party company that does the work for you. They file all the papers with with the state. They file all the papers with the IRS, and they create that entity for you, and it runs about $500 or so. Stella, you had a question, I think. Was that you?
Yes, hi.
Hi.
So if you create one LLC, can you have like two businesses going into it? So let's say I have my real estate commission checks going, protected under this LLC, but I have another business. Can they both go into one LLC?
I think I know the answer to that, but since I'm not sure, I'm going to CYA, call your attorney or call your accountant.
Okay.
What I do know is that there are many times that people, they have multiple LLCs. What I've seen happen sometimes is people have multiple businesses. Each one is set up as an LLC, and that LLC is under an umbrella holding company. That's commonly what I see done, right? Keep in mind, too, that if you own investment properties, right? If you own investment properties that you're collecting rent on, not a bad idea to have that property owned by the LLC. Again, same thing. If anybody has a slip and fall accident on your property and there's a big lawsuit, they can't sue you personally. They can only sue the company, the LLC. And I know a lot of people who incorporate their, create LLCs to hold the personal investment properties that they own. So something to think about, right? This is really going back to CYA. Call your attorney, right?
Mm-hmm.
I can give you great advice here, but I can raise the question and ask you to go and talk to the right people to figure out what makes sense for you. And if you do it right in the very beginning, I think it just saves lots of grief later on. Okay.
Right.
Question
Okay.
in the chat says, how
Thank you.
soon in my real estate career should I create an LLC? I think you should have the conversation with your attorney or your tax folks right now, even before you've got income. I think it pays to create the right structures so that when you do have the income and you go into that model that we showed with Jessica, who got her commission check, and she deposited that commission check into the bank account of the business entity. So I think you have that conversation, right now, and decide if it's something that it's worth doing, right? All right, I want to move along here because I want to touch on some of the models here. And in the MREA, the Millionaire Real Estate Agent, which is the systems and models that we teach here in real estate, the basic overarching model in the economics of your business would suggest that for 100% of your gross commission income, that about 30% of it should be allocated to what we call cost of sales, which we're going to talk about in a minute. What is that? About 30% of that is going to be your cost of sales. About 30% of it should be allocated to your operational expenses, leaving about 40% as profit for yourself, right? So 100% comes in. If there's a $10,000 check, you should put $3,000 of it towards your cost of sales. We'll unpack what that is in a second. $3,000 to your operations, and you should walk away with profit of about $4,000. That's what the economic model suggests. And again, your numbers can vary. If you can run your business more efficiently and not spend as much money in terms of your operations, then you're going to walk away with more profit, right? But that's what the 40,000-foot view model looks like. And I'm going to say that for a solopreneur, an agent working by themselves without any help, you can actually do this and become more profitable. And here's why. Because in the models, when we're saying here that you're putting aside 30% for your operating expenses, right, which is back here on this slide, operating expenses of 30%. Buried in that 30% is 12% of your gross commission income, which is allocated to salary and paid staff. And if you're a solo agent and you don't have people that you're paying, like an administrative person, or you don't have a transaction coordinator that you're paying, then you get to keep that money, but you have to do the work, right? And so it's either you do it or you pay someone to do it. This 30% operating expense includes salary. And if you're solo, then that 12% is money that you don't have to spend. You get to keep. And I said, now adjust your operating expense down to 15% because I do believe that as a solo agent doing business in the area where we are, you can run it more efficiently than that. And I'll unpack in another slide or two why I believe that. But just what you need to know is if you're working solo, that you should really probably expect to keep about 55% profit. Your cost of sales is going to stay 30, your operating expenses become less, and you get to keep more money. You have to do more work. That's the trade-off, right? And so let's unpack those ideas in just a slide or two. But before I do that, I have a poll question here. Every once in a while, I like to just kind of throw a question out there to make sure that everybody is on the same page with things that we've talked about. So we asked earlier, when does the IRS say your taxes are due? So I'm going to launch this poll. We'll leave it open for about 30 seconds or so. And I want you to just answer. When does the IRS say that your taxes are due? Got 10 people in the class right now. 4 of you have answered, so we've got more people coming on. We'll keep it open for about another 10 seconds or so. All right. 5, 4, 3, 2, 1. We'll end the poll here. And guys, I'm going to share those results. And you're right. The IRS says that the taxes are due immediately. But because it's not efficient and practical to process that kind of a flow of paperwork, they allow you to do it quarterly, and then they balance the books on April 15th. But make no mistake, the taxes are due the moment you get paid, which is why I want you to have that tax account where you just dump that in so that people, so you have the money when you need it. So it's not tax day and you don't have any money to pay, right? Okay, let's move on. Let's talk about the flow of money real quick. One of the things that we think about is that income is what comes in. And when you subtract what goes out expenses, the basic model says income minus expenses equals profit, right? It's just the basic accounting model of business. I'm going to twist that on you a little bit in a minute, but that's the way we think about it. Income minus expenses equals profit. The thing you want to think about next is when you work backwards for how much profit does it take to fund the life that I want? Because I can't fund my perfect life on money that I owe to other people. I can't fund my perfect life on money that I have to pay in tax. I can only fund my life with profit. The way you want to think backwards is start by thinking, how much profit would it take to create the life that I want? How can I minimize my expenses? And how much income would it take at the top of the funnel so that after my income, after my expenses, and after my taxes, I really have the profit that I'm looking for? We kind of work backwards, right? We work backwards as Stephen Covey, the author who wrote 7 Habits of Highly Successful People, he says, start with the end in mind. Start by thinking about how much profit I want and reverse engineer yourself backwards into how much income does it take? And then you could even go back into, okay, in order to generate that much gross commission dollars, how many transactions would that be with my average commission being whatever it is in your market, right? Now, this is where I said I'd turn it on its head. I'm a big fan of this book, Profit First by Michael Michalowicz, one of the great business consultants from West Caldwell, New Jersey, I believe, is where Mike is from. And he kind of has a different notion about profit. And he says, you know, the thing that we want to think about is what most businesses do is they operate in this model that I just showed you. They have income and they deduct their expenses, and whatever is left over is profit. And when profit is an afterthought, when profit is, I'm hoping that there's something left over, then there's really no guarantee that you're going to run a profitable business. The purpose of being in business is to create profit so that you can create your life the way that you want it to be. Money is good for the good that it does. And if we don't guarantee profit, we could be in trouble. What Michael says, and I kind of like this idea, In his book, Profit First, he says one of the things that we should do is decide how much profit we want to earn in our business. Maybe that's 5%, maybe that's 10% of your gross income. What he says is when you get that commission check and you put it into your operations bank account, before you pay yourself a salary, you should take a certain percentage of it that you're going to call profit. And you should have a separate bank account to put the profit in first. And then you put it aside and you don't touch it. And then you pay yourself a salary. And then you pay yourself, you put money aside for taxes. It's this notion that comes out of time management called Parkinson's Law. What Parkinson's Law says is that the work expands to fill the available time allotted to it. If I have 2 weeks to complete a project, it's going to take me 2 weeks. If I only have 1 week to complete a project, I'm going to figure out how to get it done in 1 week. And Parkinson's Law says in time management that the work expands to fill however much time we're allotting to the task. And what Michael does, what Mihalowicz does, is he applies that notion to operating expenses in a business. And he says businesses tend to spend however much money they have in their operating account. And if they have a lot of money, they'll spend it all. And if they have a little bit of money, they'll spend it all, but they'll be more thoughtful about how they use that money to get the outcomes that they want because they don't have an unlimited supply. What Michael says, and you might consider this, is in order to guarantee profit, take a certain percent, put it in a profit account, and don't touch it. And then you're going to have less in your operating account. But just like you do at home, when there's less money, you're going to learn how to live around the edges of that, and you're going to learn how to run your business more efficiently, and thereby guarantee that you've got profit at the end of the year. What he suggests is not only should you have a separate bank account for your profit, he says put it in a different bank. Because if it's in the same financial institution, if things get tight on your operations and you want to spend money, it's tempting to just transfer the money from your profit account into your operations account. He says if it's in a different bank, it's harder to do that. Whether you choose to run your business with a profit first mindset, I would go get the book. Profit First is a really revolutionary book, and a lot of business owners that I know are really starting to think about running their operations in this way. Where they protect, the same way that sometimes in certain religious traditions tithe. You know, you send the first 10% of what you have, you put aside for whoever's supporting your spiritual life, and you learn how to live around the edges of what's left. It's a little bit like financially tithing, but you're just doing it from a profit standpoint. So it's an interesting read. Think about if that makes sense for you or not, but something to think about. Now, income, expense, and profit. Let's unpack each one of these ideas. Your real estate income would include things like the income that you get from listing homes, the income that you get from selling homes, or income that you get when you place a referral. If you know someone who is living in San Diego and wants to move to Chicago, and you can help them get into relationship with a great listing agent in San Diego and a great buyer's agent in Chicago, you have earned the right to a referral fee. And those referral fees are income. If you are putting leases together, that lease income, right? There's lots of different ways that income in your real estate business comes into the top of the funnel. We've got to remember that income and profit are not the same thing. If we just take the income and we put it right in our personal bank account, we're treating it as profit, and it's not. It's only profit after we've accounted for those other expenses. So what business expenses do we account for? I mentioned earlier something that we called cost of sales. What exactly is cost of sales? Well, in a different industry, if I was in a company that was making black pens, cost of sales would include how much does it cost to source the material to build this thing? And how much does it cost to run the factory? How much does it cost to package these and get these out to the stores? All that stuff is rolled in. We would probably build in a profit margin as well. All that stuff is cost of sales. It's in the industry of manufacturing is what does it cost to create a product and get it to market? We don't create product like that. We're a service provider. And so for us in the real estate industry, we refer to cost of sales as the expense that it takes for you to make a transaction happen. And there's a couple of different categories of expenses that we have to think about. Number one, what do you pay your broker? Your commission split, right? Unless you own the company yourself, then you're going to have to share the commission with your broker. And in our world, we know what that is. It's 30% with an annual cap. And in most of our market centers, the annual cap here in this area is $37,000 per year. That's the commission expense. The royalty expense, something that goes to Keller Williams International, it's 6% of your commission dollars with an annual cap of $3,000 per agent per year. And that covers things like the technology, command, all of the things that we're building out in terms of the technology. It covers things like the legal departments. It covers things like everything that supports this huge franchise organization that is paid for out of the royalty, right? And that's an expense that we have to account for. So what else? Well, commission splits paid to employees or independent contractors involved in the sale. If I have a team and I'm on a team, let's say, and the commission dollars come in, but I have to share some of those commission dollars with the team, that's an expense that we would need to account for. If I had to pay a referral fee in order to get the opportunity, that's an expense that we would need to account for. And all of those expenses we call in our industry cost of sales. The big ones, the most common ones, are the split with the broker and the royalty paid to Keller Williams, right? Those are the two normal big ones. Now, let's dig into that cost of sales numbers and let's make it real and practical. What I said was that the formula is your gross commission minus your split with the broker, minus the royalty, which is 6% with a cap of $3,000 per agent per person, equals your net. And so if we were to look at this, I tried to put these numbers in the boxes, but the slides that come from Keller Williams don't allow me to make that kind of an edit. So work with me on these numbers. If I got a $10,000 check at closing, I came back to my office, I gave it to my MCA, I rang the bell, got my picture taken that showed up on Facebook, and everybody gave me Facebook love. The amount on that check is your gross commission income, right? And what is the split with your broker? It's 30% with an annual cap of $37,000. Now, the thing that you need to understand about the cap is that it's different depending on where you're doing your business. The cap is the annual maximum that your local office is going to keep. It depends on where you're doing business and the income opportunity that exists in that market. The caps can be higher or lower than $37,000 around the country. If you're doing business in Jersey City, the cap, or Hoboken, I believe the cap in those markets are closer to $45,000 because there's more income opportunity for an agent there. If you're doing business in Keller Williams Manhattan, the cap is going to be $60,000 because there's more income opportunity in the city. If you're doing business in Louisiana, pretty good chance your cap is going to be down in the 20s, maybe 24,000, maybe 22,000. Right? The caps do vary depending on the economic opportunity for the agent in that market. It's not set by your office exactly. It's set by your office and Keller Williams International. And it's set when your office is incorporated and when it's set up. But the math would be $10,000 of gross commission income minus 30% or $3,000 to your office, minus the royalty, which is 6% or $600, would leave you, if you were not capped in either of these two things, you would be actually walking away with a net commission of $6,400. That's what you would take and begin to put in your operating account and start to divide that money up into the different buckets that we talked about. Now, the formula changes when you're capped. You're going to cap on your royalty first because the royalty cap at 6% of your total commission with an annual cap of $3,000 per agent per year, you hit that at about $1.8 million in sale volume. If you did one $1.8 million house, you would probably hit that cap. If you did 3 $600,000 house deals closed, that's about where that cap is. It's about 1.6 million. And if you did cap on your royalty, you haven't yet capped on your company dollar contribution. You haven't contributed yet $37,000 to the company with $1.8 million in closings. That happens at just about 5 million in closings. That's about where you're capped on everything and you keep 100%. So in the second example, if you've capped on the royalty, it would be $10,000. You don't owe the royalty anymore. You would still owe the company $3,000. You'd actually walk away with a $7,000 net commission check. And once you cap on all three of them, you keep all 10 grand, right? That's the thing that you just have to understand is where am I in relationship to my cap? And how much do I expect to keep after I hit those caps? Any questions about capping? It's sometimes a different way of thinking about money. I just want to make sure if you have any questions about this that we answer it clearly before we move on to anything different. We good on that? If we are, we're going to keep moving. Now there's other expenses. The first set of expenses we called cost of sale. It's what does it cost to create the business. The other expenses are operating expenses. How much does it cost to run my business? And this is where you can get really efficient. This is where you can use technology. This is where you can sometimes run really lean. There's two kinds of expenses. There's what we call fixed expenses and variable expenses. A fixed expense is something that doesn't change. Whether I sell a lot of houses or I don't sell any houses, that expense is going to stay the same. Think your board dues, right? You're going to pay your board dues of whatever your dues are. Whether you do a lot of business or a little business, they don't change your board due amount. Variable expenses, they do change depending on the volume of business that you're doing. Think things like marketing expenses. The more listings I take, the more marketing I do, and I'm going to drive that cost up. Think things like signs. The more listings I take, the more for sale signs I have to own. I'm going to drive that cost up. It's dependent, it's variable. It depends on how much business I do. And what I said a couple of slides back, as a solopreneur, where you can really drive your operating expenses down in our area, it's because of this. Our average price point is really high compared to the rest of the country, even compared to the rest of the state. In Bergen County, a pretty good safe bet price is somewhere around 500, a little bit less, but around 500,000 is probably the median priced home in Bergen County. Again, there's lesser priced neighborhoods, there's higher priced neighborhoods, but 500,000 is about the average for Bergen County. The average for New Jersey is about 325,000. The average for the United States is about 285,000. And what that means is we can generate gross commission dollars with fewer transactions than we would need to have if we were in other parts of the country. Fewer transactions means less variable expenses automatically. And because that's true in our market, what I've learned through the years as a coach and a trainer is that you can probably bet on about 15% of your gross commission as a solo agent to run your operations, right? And so that's where I came up with that adjusted figure before a few slides back. It really was based on the fact that we have less variable operating expenses, but operating expenses are not what am I putting aside to pay my broker. Operating expenses is what does it cost me to run my marketing, my lead generation expenses, my educational expenses, my technology expenses. All of those are lumped into operating expenses. And so here's how we take a look at that. Well, before I get to the poll question, I'm going to unpack how those expenses look in real time on the last couple slides here. But I want to ask one last poll question regarding the economic model here. We talked about it a few slides ago. And what we said was, according to the model, let's think not solopreneur. Let's think about the traditional model. What does the model say the percentage of your GCI you should anticipate as profit? Was it 10%, 30%, 40%, or 50%? I said as a solopreneur, you can expect it to be higher, but what does the model say you should anticipate as profit? 10%, 30%, 40%, or 50%? Take a shot. This is anonymous, by the way, so if you get it wrong, nobody knows. We'll keep it open for a couple more seconds. 5, 4, 3, 2, 1. We'll close the poll. I'll share it with you. Most of you got that one right. It was the model says that for 100% of your income coming in, 30% you allocate to your cost of sales, 30% you allocate to your profit, to your taxes rather, and 40% is what you're going to have as profit. So 40% is what the model says. I'm going to tell you can drive that up a little bit higher. Okay, let's move on. We're going to go on here. Actually, you know what, guys? I just totally confused you. The model says 30%, not 40%. The model says 30% is what you should count on as profit. So anyway, let's just look at it this way. I've got so many numbers here, I'm getting you confused. I don't want to do that. If you have a profit goal of $100,000, right? That's what we're going to say. $100,000 is my profit goal. Here's the way you do the reverse engineering math to start to think about some of your key expenses. What we say is, I have to put some money aside for taxes, right? I'm going to put money aside for taxes. We're saying think 40%. In order to account for 40% so that I have enough after 40% is taken away, we actually divide our profit goal by 60%. And when we do that, it says that I need to generate 166,000 so that after 40% is withheld for taxes, I still have my 100 grand. That's the first cut on the math. Profit divided by 60% gives us the amount that we would need to deal with the taxes. Now, the second number, the gross profit goal, we're going to divide by 40%. I need then to generate $416,000 at the top of the funnel so that after all my expenses and all, everything else is put aside for taxes, I still have 100 grand. That's what it takes to walk away with $100,000 in pure profit. It takes about $400,000 at the top of the funnel. Now, once we know that, then we start to say, all right, how much is my average commission check? And let's just assume it's $10,000 to make the math easy. I divide 416,000 gross commission by 10,000 per check, and it says I need to close 42 deals, right? And we set aside for royalty and the cap. In our market, the royalty is $3,000. In our market, the company dollar is $37,000. So I'm going to put $40,000 aside to pay the broker, right, and to pay Keller Williams International. How much should I put aside to run my business? We said 30% in the model. 30% of 416,000 is 124.9. We call it 125. I'll throw in the last buck. 125,000 is how much I have allocated to run my business. It doesn't say I should spend every penny of that. It just says try not to spend more than that, right? And so in order to net 100,000 profit and have the money to put aside for taxes and have the money to pay their broker and have the money to run your business, it's going to take about 416 at the top of the funnel, which is about 42 deals. Now, for the solopreneur, because you can run more efficiently, to get to that 100,000, we're still going to have to account for the taxes. I need to get an extra 66,000 to pay the tax man. But now, because your profit is higher, we divide this number by 55%. Now I only need to do 300,000 in sales because I'm keeping more profit. We divide that by our 10%, $10,000 commission. Then I only need 30 deals. I can do 12 less deals per year as a solo agent without having all the staff overhead that happens when you're running a bigger business. I'm still putting aside the $40,000 for the royalty and the cap. My operating expenses now are 15% of this number, which means I have 45,000 to run my business. Remember, because you're not paying other people to do certain tasks, you're doing those yourself. It's going to be more time intensive, but less dollar intensive, right? That's sort of how you back into some of those numbers, some of those models. Now, last slide coming up. Before I do that, I threw a lot of numbers at you guys. I'm pretty sure your heads are spinning a little bit. I saw a number of people jump out of this. I think it got a little complicated. I'm going to encourage you to go back and watch this again. And if I've confused you before where I kind of juxtapose the profit numbers, go back and watch this again. And take a look at the model numbers in the MREA. What we know way back up here, let's go all the way back on these slides. This is what we're thinking about, according to the basic model. 30% cost of sales, 30% operating expense, net profit 40% on the solo model, 30% cost of sales. Trim your operating expenses to 15% because you are doing the work yourself, and because in our world, variable expenses are lower, your profit is going to be higher. It's just the way it's going to work, right? That's the 40,000-foot view. The very last slide here is this one. Let's go through all these numbers one last time. Here's the very last slide. Best practice. Get clear on how much profit you're trying to generate. There's a path to any number you want, but the path is different. As a coach, I've coached people to annual profits of 20 grand. I've coached people to annual profits over 7 figures. It's a very different path. Sometimes that's a solo agent's path. Sometimes it's a team's path. But it really comes down with getting clear on what are you trying to do? How much profit does it take to create the life the way that you want it? And then building a business that is designed to make that real. Set your personal and business budgets. Know how much you have. Parkinson's law is a real thing. You'll spend as much as you put in that operating account. I like Mike Michalowicz's idea of protecting the profit first. Just take a few percent and put it into a different account so you know you're always going to have profit at the end of the year. But set up your business budgets. Set up your business entity if it makes sense. Talk to your attorney. Talk to your tax preparers or your CPAs and decide whether becoming an LLC makes sense for you, or an S Corp, or whatever makes sense, right? Make sure that you open up the right bank accounts. Do not run your business through your family's personal accounts. Download the MREA chart of accounts. What is that? That is actually the ledger, this Excel spreadsheet that has all the different account headers. How much should, that has an account for your technology expenses, for your telephone expenses, for your educational expenses, for your marketing expenses. It's a spreadsheet that's already got all of that mapped out, which you can give to your accountant if you want, and say, hey, use this as a way of kind of running my business consistent with the way that the Keller Williams accounts would suggest. You can find that MREA chart of accounts on the KW University website. If you have a problem finding it, sometimes they take it down, sometimes they put it back up again. If you can't find it, I have a copy of it. And just reach out to me and I'll email you the spreadsheet, right? But download that chart of accounts and think about running your business that way. Purchase tax accounting software, I think sometimes is a good thing to do. QuickBooks makes a lot of sense for a lot of folks running small businesses, but have an accountant, have a CPA if you need one, but certainly an accountant or a bookkeeper to handle your books. An attorney, make sure that you've got the right team there. And if you can do it yourself, great. If not, you're going to probably want to hire a professional. Set the dates, put them in your calendar, know when you pay your taxes, estimate that appropriately, send that money along. And then finally, sort of doing that last calculation that we showed in terms of doing the math backwards to figure out how much gross income do I need to generate? What would my operational budget look like to generate the profit that I'm looking for? And that's the exercise that we just kind of ran through quickly. So we covered a boatload of ground here in this hour. This is probably the session that I know is a little bit the most confusing. I'm going to encourage you to watch it again if you want to. I'm going to encourage you to reach out to me and ask for any kinds of clarification. Jump on an office hour if you have questions about this. Give me a call. Send me an email. I want to make sure that you get this, though, because I want to make sure that you're treating your business like a business and not like a hobby, because there's too much at stake. You are a small business owner, and you need to understand these basics to treat it that way. So with that said, any questions? We're a little bit over time. Any questions that I can answer before we jump? Any ahas or any lingering questions before we wrap it up for today? You can feel free to unmute. You can put it in chat if you want. Going once, going twice. Great session. Okay, Chrissy, you know what? Here's what I'm thinking. I just noticed in chat that there is the ability for me to upload some things. And I believe that I might be able to find real quick that chart of accounts and see if I can put it in here for you, save you the need to go down and try to download it. So here it is. I found it on my computer. and it should be loading up as a PDF into the chat box. You can just download that yourself. It says 2009. That was the version. That was when it was created. Download that if you want to. It should be a PDF, I believe, but I think it would still work, for you to kind of give to your accountant and say, here's all the different chart of accounts, or at least you could set it up with your software if you're going to run QuickBooks. Again, any questions that you have, feel free to reach out. We're going to finish Ignite on Friday, where we're going to talk about contract to close, all the different steps to make sure that your deals stay together and get to the closing table. That's the last session. So we're going to do that on Friday at 11 o'clock. So I hope to have you guys come back again. I hope there was some good stuff in here as you start to think about your business and doing it the right way. In the meantime, guys, have yourself a terrific day, and I'll talk to you guys real soon, all right?